For joining. Can you hear me all right?
Yep.
Yeah.
Good morning.
Yeah. Thank you all for joining. I'm going to give an overview of STAG Industrial, and then I will open up to questions. We're going to mix things up here. We've gone through many medical office REITs, so I think we're the sole industrial REIT at this conference. My name is Bill Crooker. I'm the CFO. To my left is Matt Pinard. He's the Senior Vice President of Investor Relations and Capital Markets. STAG Industrial is an industrial owner and operator of real estate. We're a public REIT with the ticker STAG, listed on the New York Stock Exchange. We're about $5 billion in enterprise value, a little less than $4 billion in equity market cap. We pay a 5% dividend. We pay that on a monthly basis. We've been a public company since 2011. And since that time, we've grown our dividend every year, and sometimes multiple times a year. We've also returned approximately 300% total shareholder return since our IPO in 2011. We have about 400 buildings. We operate across 38 states, widely diversified, and really our focus is on cash flow, and that cash flow has resulted in, as I said, a 5% dividend, but also the ability to provide income to our shareholders as well as growth, because we've got a wide opportunity set to continue to grow our company. Next page is some representative properties. I'll get into this a little bit later, but these properties that we own are generally big, simple buildings. On average, building size is about 200,000 square feet, single tenant building. And the reason our buildings are single tenant, this goes back to the investment thesis. Our CEO and founder founded the company back in the early 2000s. As I said, went public in 2011. And the investment thesis was to buy individual binary risk cash flows. And those binary risk cash flows have a higher yield, a higher cap rate. So for example, we're buying individual buildings today at a 7% cap rate. So a $10 million building will produce $700,000 of income. The trick is with single tenant properties, because they're binary risk, you're either getting on average $4 per square foot in rent, or you're paying $2 of expenses. So because of that binary risk, you need to get a higher return, that 7% cap rate as I alluded to. But as you aggregate those binary risk assets into a portfolio, you've diversified the risk, and you've effectively created a virtual industrial park. And by diversifying that risk, we've created value in a portfolio. So we've demonstrated this several times pre-IPO and a couple times as a public company, where we've sold portfolios, small portfolios, that have created contemporaneous 100 to 150 basis points of cap rate compression, so the value by just aggregating those single tenant binary risk cash flows. So that was the thought, that was the thesis. It was tested, proven, and then after that it was like, well, what type of real estate should we invest in? And that's what went to industrial real estate. And the thought there is big, simple buildings. So as I said earlier, we're focused on cash flow. So industrial real estate is the lowest capex real estate out there. So really, if you think about it, it's four walls and a roof. And so when you think about the capex load, it's very low. Then there's a large market of industrial real estate. We estimate about $1 trillion of industrial real estate, and it's highly fragmented. Green Street just came out with a report that the top 20 industrial owners own less than 10%, or approximately 10% of the stock. So there's a lot of owners of industrial real estate that own 2, 3 buildings. And so for that reason, there's uncorrelated reasons why assets are coming to market. A partnership could just break up. Owner needs to put his kids through college, wants to buy a boat, whatever the reason may be. But there's an uncorrelated reason. So through cycles, you're always seeing continued opportunity to acquire industrial real estate. And lastly, so that was the reason to go industrial when we first started the company. We've been fortunate enough over the past 5 years or so to have this e-commerce tailwind as well. So e-commerce has created just incremental demand for industrial warehouses. Typically, industrial rents would grow. It's highly correlated to the growth in GDP. So it goes up 1 or 2% a year. But now you've got this incremental demand driver of e-commerce, which has allowed us to drive rents, grow cash flows, and distribute those cash flows to our shareholders. So we've been pretty fortunate there, and I think from an e-commerce perspective, we're still early stages of e-commerce. So you think about the percentage of e-commerce or retail sales, what percentage of e-commerce or retail sales are, it's still relatively low in the United States as compared to the rest of the world. The next slide is target market size. So we estimate to be about $1 trillion. About half of that is single tenant, and then half of that we estimate is about what we would invest in. So that could exclude the top 6 markets where we don't find the right appropriate value in those markets. There's too much dollars chasing industrial e-commerce buildings in the top 6 markets, so we stay away from those markets. We invest in about 60 markets, and these are NFL cities. One of our top markets, our third biggest market, is Greenville-Spartanburg, and that, for whatever reason, our public peers have made decision rules to not invest in those markets. Greenville-Spartanburg is a growing population, generally younger population. It's got a B&W manufacturing plant. There's some challenges to develop certain parts of that area. So for all those reasons, it's been a great industrial market, and we're able to acquire assets at a 7 yield there. So it's a pretty attractive investment. And when you look at where some of the industrial product is trading at in the top markets, top 6 markets, you can see some buildings trade for 3.5, 4 cap rates. Slide 5 here. I'm not going to get too detailed here, but this is just showing the volatility or what rents and occupancy have done across various markets. So you've got the top 6 markets, which we've identified as super primary, and then you get secondary and primary markets as well. And if you look at this chart, what you see is that the volatility in these markets is very similar. So if the volatility of occupancy and rent growth is very similar, then you would think you'd have a similar going-in yield, but that's just not the case. So we're able to have a higher going-in yield with very similar volatility with occupancy and rent growth. So we're able to discern a lot of relative value by acquiring in the markets we acquire in. And we do, as I said, we own about 60 markets, 60-plus markets, and we stop our vertical integration at the asset management level. So what I mean by that is we don't have a property management function. And that's because by owning single-tenant buildings, the property manager generally is the tenant. So for us, it's allowed us to cast a much wider net and invest in more markets without having boots on the ground and having that incremental G&A load. And so it's been a great opportunity. And when you have a tenant that's managing the property, they're managing it because they treat it like it's their own. So it's been working out very well for us. The next 2 pages is just a lot of information. I told Matts to remove these. He did not. So this is on our website. I encourage you to look at this. I will also take questions. But this just goes, we're a very data-driven company, and we take a data-driven approach. So this just walks through some of that data-driven approach in terms of investing in secondary primary markets, not just super primary markets. Discerning relative value. So we've been very acquisitive since our IPO. We have acquired, on average, 25% of our portfolio each year. This year, we're right around 20% of acquisitions, and from a net acquisitions higher than what we've done in the last year. Now, the risk there is that you just grow for growth's sake, and that's not what we do. We have built up our people, our processes, and our systems to look at a number of transactions a year. Last year, we looked at 286 transactions, and we closed on 46, so roughly a 16% hit rate. Our hit rate has been right around 10 to 16% every year. And so the 84% that we didn't buy was solely due to price. It's very easy to be a real estate investor and fall in love with the building. You look at the building, it's pretty, it's great, and you want to buy it. And then next thing you know, the price goes up, and you just get attached to it. And it happens with residential real estate as well, and you end up buying it, and you overpay for it. For us, we focus on cash flow. So we have checks and balances in our underwriting. We go through all those checks and balances, and at the end, it spits out what we think is the appropriate cash flows coming out of that investment on a probabilistic basis. And then from there, we determine what the appropriate price to pay. And we look at a number of different factors. We look at 10-year IRR. We look at average cash flow over a 3, 5, and 10-year period. We look at average cash available for distribution over a 3, 5, and 10-year period. And we look at an average FFO per share over a 3, 5, and 10-year period. And from all those factors, that creates what we're willing to pay. And to the extent that we get outbid, then that's fine. We'll move on, and we'll continue to look at other buildings. But investing in these markets, I use Greenville-Spartanburg as an example, we're one of the largest institutions investing in those markets. So we have a ability to not be the highest bidder and win on a transaction, and that's because of surety of close. A failed real estate transaction can be very costly for the seller. I mean, just think about if you're going to buy a house, and so the buyer before you had it under contract and they backed out. Well, why they back out, you don't really know. You think you know, you don't know. So that impacts your price. So we're often the second highest bidder, and we win the transaction just because our ability and our surety of close. We do a lot of underwriting before we even get into the bidding process. So investors, brokers know us, and they know that our bid is good, and we will close in the transaction, so long as there's not something comes up major in diligence, like an environmental issue or something like this. Page 9 is a good illustration of this volatility of cash flows. So the first graph there shows what a single asset cash flow is on a probabilistic basis. So this is, it's got a 5-year lease, it's 75% renewal probability, you're getting $4 rent. When the 25% chance they leave, you have to pay expenses. So you look at that cash flow, and you need to get paid to take that risk. But then when you aggregate into this portfolio, that's when you mitigate a lot of that risk, a lot of the volatility of the cash flows. You create that virtual industrial park. And then that generally trades for 100 basis points or 150 basis points inside of where you can acquire that individual asset. So you buy it for a 7, you can sell it for 5.5 cap rate, create a lot of value there. And then the next leg is the enterprise value, and that is when you look at all 400 of our buildings, what do those cash flows produce, and then you layer on the external growth for 10 years. So you look at that set of cash flows, you compare that to any of our industrial peers. Let's say on a volatility basis, it's very similar, but it's more upward sloping due to the external growth opportunity we have, and not self-selecting into a handful of markets. Page 10 is just an illustration of two portfolio sales we executed on. One was the end of last year, where this shows a cap rate compression of 1.8%. Part of that was some market cap rate compression. This portfolio traded for about, on a contemporaneous basis, where we could buy assets of similar quality in the same markets at the same time, about 150 basis points. And that's the same thing with the 2016 portfolio, but we just had a lot more market cap rate compression there as well. And this, as I said, we've executed these transactions, these trades as a private company as well. We remain highly diversified. So again, focus on cash flow. We want to mitigate any risks, any correlated risks here. So we're highly diversified across markets, across industry, across lease terms, and we also have a very well-laddered maturity schedule from a debt standpoint. We're investment grade rated by Moody's and Fitch. So as most of the REITs do, we're very well positioned. We've got a lot of liquidity, and our debt to EBITDA right now, we just did an equity offering, is about 4.3 times. So well within where Fitch and Moody's would want us to operate to maintain our rating, which is right around 6 times. So a lot of capacity there. From an operations standpoint, so as I said, our vertical integration stops at asset management. A lot of our growth comes from an external growth perspective, but what our operations team is doing is also delivering growth. We just put up a same store for the first quarter of 3.5%. On a normalized same store for this quarter was about 2.7%. So you couple that internal growth with the external growth, and you can see how this drops to the bottom line and drops to the investors from a dividend perspective, as well as a share price appreciation perspective. In addition to leasing, retention, Our operations team has, they've leased almost 45 million square feet since our IPO across all different markets, and they've also created value through expanding buildings and through redevelopment and repositioning buildings. We have not executed on any speculative developments at this point. We do have one small one underway now, which we expect to get about a 50% return on cost. So pretty attractive. I wish there was more of those, but doesn't seem to be that many left in the portfolio. But from an expansion standpoint, there's a lot of our buildings have excess land. The number one reason why a tenant leaves our building is that they grow out of the building. And so when we underwrite a transaction, we look at how the tenant's utilizing that operation, that building, and if they're full and they're busting at the seams, a lot of investors will look at that and say, "Oh, that's great." We look at that and say, "Well, that's terrible. They're gonna move out of here when their lease rolls." But if you have that ability to expand the building, that's a great opportunity to expand the building for them and extend both their original lease and their expansion space on a coterminous basis. So we've done a number of those. There's this continued opportunity to expand the buildings in the portfolio. Page 17 is just some more case studies in terms of value creation. There's a lot of these opportunities in the portfolio. From a disposition standpoint, we've disposed of 2 portfolios as I went through, and there's always opportunistic dispositions, what we refer to them as, is $100 to $200 million of opportunities that are unidentified in the portfolio where we execute a disposition. So an example of this is maybe we have a vacant asset and a user comes and wants to pay us what occupied pricing is for that asset, and if that's the case, we'll execute on that transaction. All of our opportunistic dispositions have yielded greater than 10+ unlevered IRRs. So great transactions for our shareholders. We're able to take that capital, redeploy it accretively, and continue that growth. Tenant profile, by having large, simple buildings, on average 200,000 square foot buildings, those are big, sophisticated tenants. Now, our average tenant credit rating is about BB-. Large tenants doesn't always correlate to a higher credit rating, but what does correlate to is if they ever do have financial difficulties, there's a higher likelihood that they're going to not liquidate upon bankruptcy. And what we do is we focused on buildings that are critical to tenants. And we had a last year we had a small bankruptcy mattress firm, for example. What they did was they shut a bunch of their retail stores, but they kept their distribution center, which we operated in. So they didn't miss one rent payment. They're on time with everything. So really no issue for us. But that was just a financial bankruptcy to shut some of their retail stores. So that's a key part of our underwriting. As I said, balance sheet, very strong. I'm not going to go through all the metrics here. Very similar to the other presentations. Defensive, a lot of liquidity. I would say, lastly, before we get into the questions here, is if you're looking at real estate, I don't disagree with what some of the medical office folks have said, but industrial real estate, it's very hard to say that this isn't the best asset class right now. With the continued growth of e-commerce, we don't see supply coming online in our market. Supply is really concentrated in a handful of the top markets. So we're able to drive growth. Our releasing spreads this first quarter of 15% on a cash releasing spread. So that's what they last paid on the rent to what we just rolled them up to. And that was on 2.5 million square feet, which is a pretty big leasing quarter for us. So you look across that, it's a great sector, industrial real estate. You look at a dividend yield of 5%. We pay it monthly. Not sure why the other REITs don't pay it monthly. But we pay monthly dividend. And if you look at the valuation compared to our peers, we still have a pretty big gap to bridge there. So we're at internal growth, external growth, monthly dividend, cash flow payer in a great sector with a large opportunity set. There's the ESG slide, which I think it's important, but I'm not going to go through it right now. It's on our website if you want to read through that. And then in summary, as I said, it's a great, large, persisting opportunity, uncorrelated reasons why assets come to market, and allows us to continue to grow externally, as I said, internally, and grow the cash flow and dividend. And with that, I'll open it up to any questions. Why don't I take the lady here first? Brad. Sorry about that, Brad.
I might have missed it. Are they all triple net leases?
Yeah, good question. Sorry, I didn't say that. Yes, triple net. 95% of our leases are triple net. What I mean by that is they pay all the operating expenses. We're generally on the hook for the roof and structure, but that's all factored into our payout ratio, et cetera.
And also one more, are you investing yet, or do you plan on investing in opportunity zones?
We've looked at it. We have a leg of our operations teams that's looking at it. Right now, it's not a near-term opportunity for us, but it's something we're evaluating. Thank you. You can go here and then here.
What's an example of some of your e-commerce clients engaged in your portfolio?
So e-commerce clients engaged in our portfolio. We did a tenant survey last year. About a third of our portfolio has, a third of our buildings have some sort of e-commerce activity going on. 10 to 15% are solely e-commerce dedicated facilities. DHL is an example. XPO Logistics, Amazon. So those are some of the tenants that have e-commerce dedicated facilities in our portfolio. I will say though, we don't have a large exposure to FedEx, but FedEx generally does like a build-to-suit building, so they do a very specialized, very above market rents. So upon roll, you're going to roll down, you're going to lose a lot of that cash flow. So that's something we focus on and not get too above market rents because you don't want to roll down and have an issue with your coverage on your dividend. Brad?
So, Stag listed just coming out of the recession, so it really hasn't gone through that recession yet. So in terms of the next recession, which is coming sooner or later, can you talk a little bit about your retention? I know you've had some somewhat lumpy retention, but more recently it's been in that 75 to 80% range. So can you talk about how you're preparing for that next recession and retention, and also your reduced payout ratio, which congratulations, good quarter, first quarter.
Thank you.
Talk a little bit about how you make that dividend safer as we move into this next recession.
Sure. A recession will come. I think we've all been predicting it for years now. It still has not come, but it will. From a retention standpoint, long-term industrial retention rates is generally in that 70 to 75% ratio range. We've been operating, as Brad said, 75 to 80%. There was a little lumpiness when we first came out as an IPO. Some was greater than 75, 80%, some was less. And that was largely due to just a smaller portfolio. So one building moves your retention number, so you get a little more volatility. We are in constant contact with our tenants. We're talking to them 1 to 2 years in advance, getting ahead of lease rolls. And a lot of time, even though we see we think a recession is coming at some point, maybe the next 18, 24 months, tenants are signing longer term leases with the highest contractual rent bumps that we've seen, and on average 2.5 to 3%, when normally these are 1 to 2%. So we're signing, if you look at what we've acquired and what we've signed over the last 2 years, longer term leases with higher contractual rent bumps, so with very high retention numbers. So for us, as we continue to grow, we've got a great operations team. We're in front of tenants. We buy from, I would say, less sophisticated investors. So we come on as a landlord. Tenants are very happy to have us because if there was a roof that the old owner was just limping along, we come on and replace the roof because we've got the capital to do that. So we're a good landlord. They like to be in our buildings. And as I said, the retention rate is high, so they like to stay there. So just getting in front of a tenant's longer term leases, so long as we're comfortable with those economics, and it's always a balance. We look at what the cash flows are over a 10-year period, and we'll evaluate whether we want to go longer or shorter. But lately, it's been longer, both on acquisitions and new and renewal leasing. And from a payout ratio, our payout ratio was a little bit north of 100% when we came out of our IPO. It's well below that now. It's fully covered dividend, and that's a dividend that, as I said, we pay on a monthly basis, and we've grown at least once a year, in several years, twice a year. So covered dividend, we're dedicated to continue to grow that dividend at least on an annual basis. So it's something you should expect as we continue to grow. Yes.
Do you do anything with opportunity zones?
So we have a group that is looking at that. Nothing in the near-term pipeline, but something that we're looking into.
The increasing demand for automation in the warehouse expenses, is that you as the landlord or the...
It's the tenant. So the tenant, it's their expense. and there's generally restoration clauses in their leases. So to the extent that they outfit the interior of the building, then they need to bring it back to the use that we gave them the building at. So it's almost solely on them. Sometimes when you've got a build-to-suit, though, as I mentioned in the FedEx example, the landlord will take on that expense and push rents higher, so the tenant will pay that expense back to you over the lease term. But what that does, it creates a situation where you have a very high above-market lease, and its cash flows are going to roll down at the end of that lease. So we don't typically do that. You're welcome.
Does the fact that a lot of these tenants might require some specialized investments?
You would think so. If they're putting that investment in the building, they're generally stickier. Now, a lot of these big buildings, I mean, Amazon is the poster child for this, has a lot of specialized stuff inside of their buildings. Those million square footers, 1.2 million square foot warehouses haven't been tested on the renewal and what happens when those roll. I can tell you what for certain, the rents are going to come down, right? They're paying above market rents. So I would say on average, it probably makes them stickier. I mean, that's something that we look at. And if a tenant has invested their own dollars into the space, I think, yeah, it absolutely increases their renewal probability. We're running out of time to list all of those competitive advantages, but I would say the biggest is that we don't have decision rules in terms of investing in a discrete number of markets. We're investing in 60 plus markets. So one of our peers invests in 6 markets, another peers invests in 12 markets. Well, what's the difference between 6 and 7 there? What's the difference between 12 and 13? So those types of decision rules is where we feel like we can take an advantage. And operating in 60 plus markets is one of them. I would say, we see this going up against some of the solely net lease investors is they'll buy a 10-year lease, but they won't buy a 9-year lease. Well, the difference of cash flows over 10, 20 years, or the difference between a 9-year lease and 10-year lease is not that great, but sometimes they'll bid 100 basis points difference just by that 1-year lease term. So we try to play on those decision rules overlays is the way we look at them. So that's just probably our biggest competitive advantage. Mm-hmm. Mm-hmm. Yeah, cold storage is so when we talk industrial real estate, we have light manufacturing that's more of assembly type of tenants. We have some of those in the Greenville-Spartanburg area servicing the BMW plant. Then we have warehouse distribution. So these are big, simple boxes where you've got tenants distributing goods at some point of the supply chain. From a cold storage perspective, we don't have many. We have maybe a couple of buildings that have a box-in-a-box cold storage facility. So it's not the fully specialized cold storage facilities that you're referencing. I do believe that those facilities do have higher retention rates. Significantly higher CapEx too. So for us as a cash flow investor, we look at the dollars in, dollars out, and where those dollars are going to drop to the bottom line. So that additional CapEx expense is something that we're not comfortable taking on with those type of buildings. Any other questions? Well, I thank you all for your time today and appreciate you coming for our presentation. And hopefully you can join us for Brad Thomas's panel coming up here shortly. Thank you.